The market for Cidara Therapeutics, Inc., trading under the ticker CDTX on the NASDAQ, is currently closed. The last recorded price from the close of the most recent trading day, Friday, November 14, 2025, was $217.71 USD, marking an astounding intraday gain of $111.72, or 105.41% from the previous close. The sheer magnitude of that single-day move is what should immediately grab the attention of every investor, from those using sophisticated platforms like interactive brokers to casual users on the Robinhood app, because a triple-digit percentage gain in a single session for a biotech stock is not just a volatility event. It's a seismic shift rooted in a fundamental and, in this case, publicly announced corporate action. This immediately shatters the expectation that a biotech company, particularly one with a track record of consistent losses and pipeline risk, would continue its slow, volatile grind. The reality is that the volatility has collapsed into a certainty event, a massive premium placed on the stock overnight that changes the entire investment thesis. The general belief around Cidara Therapeutics, especially in the broader investing community, has been characteristic of the small-cap biotechnology space: high risk, high reward, dependent on clinical trial data, regulatory approvals, and the constant need for new financing through stock offerings, a dilution cycle that often penalizes long-term holders. Investors following biotech stocks, whether they manage their own holdings on a Fidelity brokerage account or utilize a service like Schwab Intelligent Portfolios, understood that Cidara's primary value hinged on the success of its proprietary cloud-break drug Fc conjugate platform, specifically the lead candidate CD388 for the prevention of influenza. The expectation was a steady march through Phase 3 trials, with intermittent positive or negative data releases driving minor, albeit sharp, daily swings. The reality, delivered late last week, is that the entire clock has been sped up and the risk matrix fundamentally altered. The massive spike in CDTX stock is a direct consequence of the definitive agreement for Merck to acquire Cidara Therapeutics for $221.50 per share in an all-cash transaction. This news acts as a massive and immediate catalyst, transforming CDTX from a speculative clinical-stage biotech into an arbitrage play locked just below the acquisition price. The acquisition price itself provides the anchor for the stock's current valuation, explaining the dramatic leap to $217.71 USD. The 105.41% gain in volume of over 17 million shares, an astronomical figure for this stock, clearly reflects the market swiftly adjusting to this premium, essentially pricing in the near certainty of the deal closing. The volume wasn't retail speculation, it was professional money, including likely arbitrage funds and institutional holders reacting to a hard number. For those practicing online investing and self-investing, this kind of news is the ultimate payoff for holding a risky asset through years of development. Looking closely at the intraday movement on Friday, the stock opened near the acquisition price, around $217.20, and traded in a very tight range with a high of $218.85. This extremely compressed trading range is exactly what you see in a pending merger and acquisition situation, where the current stock price is essentially tracking the spread, the difference between the trading price and the cash-out price of $221.50. This small gap, which is currently about $3.79, represents the time value and execution risk associated with the merger. Institutional owners, of which Cidara has a significant number, including Raw Capital Management and Bain Capital Life Sciences, have likely been either tendering their shares or holding firm, confident in the closing. It's a textbook demonstration of how M&A activity instantly shifts the conversation from pipeline risk to merger completion risk, which is a much lower, more quantifiable factor. The central asset driving this acquisition is Cidara's lead candidate CD388. This is a long-acting antiviral drug designed to provide universal, single-dose prevention of seasonal and pandemic influenza, not just for healthy people, but crucially for high-risk populations who often do not respond well to traditional vaccines. For Merck, this is a strategic move to immediately diversify its portfolio with a late-phase antiviral agent. The Phase 3 anchor study for CD388, which is currently enrolling high-risk patients, represents a huge market opportunity. Merck is essentially paying a premium to inherit a potentially first-in-class product with a strong commercial market estimate. Some reports suggesting peak sales projections near $2.8 billion for the U.S. market alone. This valuation is what justifies Merck's $221.50 per share offer and provides the definitive reality check for those who viewed Cidara stock through the lens of short-term quarterly misses. Cidara Therapeutics' underlying business model centers on its Cloudbreak DFC platform, a unique technology that creates single-molecule cocktails by coupling targeted small molecules or peptides to a human antibody fragment. This mechanism is designed to confer potency, selectivity, and an extended half-life. Before the Merck acquisition, the company had already secured FDA Fast Track and Breakthrough Therapy designation for CD388, a crucial de-risking step. Additionally, they had a prior successful divestiture of their antifungal drug Resifungin to Mundipharma, a move that provided non-dilutive capital and allowed the company to focus its resources almost entirely on the higher-value Cloudbreak DFC pipeline. This strategic focus, which was often criticized by bears for shrinking the near-term revenue base, is now clearly validated by Merck's interest in the core technology. The recent positive Phase 2b Navigate data for CD388, showing up to 76.1% prevention efficacy, laid the groundwork for the high valuation and was the final piece of clinical data that made the company an irresistible acquisition target for a pharmaceutical giant like Merck. The future outlook for CDTX stock is now entirely tied to the closing of the Merck acquisition, which is expected to happen in the first quarter of 2026. This transition turns what was once a biotech speculation into a cash equivalent holding, a common process when large individual brokerage accounts and institutional portfolios consolidate their gains. The primary risk is no longer clinical failure, but rather regulatory hurdles from antitrust reviews or a failure of the tender offer conditions, which typically require a majority of Cidara stockholders to tender their shares. Given the massive premium over the pre-announcement trading price, the tender offer is expected to be successful. Any small fluctuations in the stock price from here until the close are simply minor market-driven adjustments to the probability and timeline of the deal completing. This is a very different kind of risk calculation than assessing the success of a Phase 3 trial. The only potential for a significant downside would be a failure of the deal, which would send the stock plummeting back to its pre-announcement levels, which were in the low $100. However, the board of directors' approval from both companies suggests high confidence. For investors who are used to the volatility of growth stocks like Tesla stock or the semiconductor supply chain discussions surrounding Nvidia stock, the action in CDTX is a powerful reminder that fundamental biological or technological breakthroughs can instantly wipe out years of stock market narrative. Whether you prefer the control of self-investing through an interactive brokers platform or the guided approach of intelligent portfolio products, the outcome here is the same: a clear, authoritative signal that the company's core intellectual property was worth significantly more to a large acquirer than the public market was willing to pay before the announcement. The market's expectation for a small biotech like Cidara was continued high burn rate and trial uncertainty. The reality is a multi-billion-dollar exit that confirms the immense value of their DFC technology. This is a clear victory for the patience that long-term investment requires in the biotech sector. I want to know